please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. It is genuinely a good morning. Surabhi is there with me to share the enjoyment. I have never been more convinced and more happy to announce that this long-awaited U-turn in the second half is definitely here this time.
Woohoo! I feel like whistling already, Latha.
3 years in a row, we have been saying the second half will be better than the first half. But now there are definite signs that this is not just a long recovery, but it's almost V-shaped. It's an excellent GDP number that we have got. Of course, the global backdrop now is, although despite a monster rally, the Senate not passing the tax reforms may create some bit of jitters in the global market at this point in time. And the overall backdrop has been preferring developed markets to emerging markets. My sense is that this GDP number is good enough for people to say, I don't give a damn about EMs. India is the story. It's as good a number as that.
Fantastic. What a note to start Friday on. And, you know, I was just thinking of the same thing, Latha. Of course, I'm going to come back to you and we'll get deeper into the more granular details of that number in just a moment. But I was just thinking this, because yesterday, the manner in which the bears charged on the street, the kind of bear attack that we saw, is a lot of that going to be undone today? Of course, it's also the start of a new series, but the cues are stacking up against the bears. Perhaps we can, you know, both agree on that. So the global picture, yes, there is a bit of a, an impediment. You can say that. The vote was supposed to happen early this morning, our time. It's been pushed back. Republicans are still trying to clobber sort of support together. There are a few sticky areas. Yes, there are a couple of Republicans who are arguing that, you know, there's too much of a fiscal deficit impact and they want sunset clauses, the sunset dates of all these tax cuts to be preponed a little bit. There is obviously the populist sort of debate on who this really benefits. Why are you benefiting big business? What about the small businesses in the US? So those are some of the niggling, you know, political points of debate. But the general sense seems to be that it is only a matter of time. It's just when and not if that this becomes a reality. Dow futures, obviously, after that humongous rally, have shown a bit of a pullback. Let's actually get Dow futures up for you if we can pull that up. They've been down between sort of 40 and 50 points right from the morning. And if we take a look at, around 55 points. And if we take a look at Asia, aren't sharing that euphoria that we saw on Wall Street yesterday. It's a more measured approach to things. Points right from the morning. And if we take a look at, around 55 points. And if we take a look at Asia, aren't sharing that euphoria that we saw on Wall Street yesterday. It's a more measured approach to things, but you're seeing more green on the screen.
They started higher.
Yeah.
The Senate breaking news came in, and they're all off highs.
Exactly, but there's still some green there on, you know, on some of the markets in the region, barring Taiwan. For us, the SGX Nifty obviously is the watch point, and that continues to be flattish, but the bias is positive even there. In fact, the SGX Nifty will come up about 6-7 points higher. Okay, so yeah, just about climbing back to that flat line as we speak. But Latha, the big story, what is getting you so convinced in that GDP number? Where are those sort of hidden pointers that tell you that this is for real?
Well, you know, 6.3 is what Ekta's poll said, and 6.3 is what we have got. So why am I more happy than that? See, what has been contributing in the last quarter, for instance, was agriculture, which had grown at 2.7% in the first quarter, and government spending. Government spending last year was 17.6%. Last quarter was 17.6% first quarter. Government spending petered out in the second quarter. I mean, it's just about 4.1% higher than the year ago quarter. So government spending is considerably lower. Even if you look at public administration, in the output side, there is an entry called public administration, defense and services. That had grown by 9.5% in the first quarter. In this quarter, it grows by just 6%. Okay. So clearly, government has not contributed. Agriculture had grown by 2.7% in the first quarter. It has grown by just 1.7%. So you take the entire GDP and deduct agri and government. And if you take the balance, that has grown by 6.8%. So this is private sector manufacturing and services in the second quarter has grown by 6.8%. Our GDP is not the 6.3 number, but it is 6.8 if you looked at the sector which the stock market should measure, the sector which was lagging because of lack of capex. So that is what is the exhilarating part of the second quarter GDP. Now, that doesn't mean we don't have downsides. Construction is bad, 2.6%. It's better than the 2% in the first quarter. But if you take first half, construction is only 2.3%. Agriculture is only 2% if you take the first half. And those are the employment generating sectors. Agriculture and allied is 50% of India. In the remaining part, construction, takes away a good 20% of India's job growth. So if we don't have those two sectors kicking, rural distress will continue. So there is that pain point, but the positive is that what was not performing, private sector, manufacturing and services has
started moving. I just have one follow-up question on the gross fixed capital formation number, which is about, I think, 4.5%, and that is one of the high points, as the finance minister also pointed to. How do you interpret that? I mean, is that something that we can really hold on to?
No. This is the expenditure side of the GDP, which actually is a little less reliable. It's a derived number. You can say that of the entire GDP because it's only an extrapolated number, sometimes extrapolated from taxes, and this time tax is a confusion. So you can, find faults, pick holes in this number everywhere. That's why I didn't mention too much about capital formation. But you're absolutely right that, capital formation at 4.6 is about the best number I've seen in many quarters. So that does indicate that some bit of capex. Ramakrishna Forgings told us that. Yesterday, who was the other guy who was saying that I have to expand capacity? I mean, we have had anecdotal evidence of people saying that we are operating at 90%. So capex is somewhat picking up, and that 4.6 number is definitely exhilarating. It's a far cry from what we used to do. At one point in time, as a percentage of GDP, our investment used to be 37-38%. Today, it is still only 28%. So, that way you can look at it as a glass half full. The 4.6% is also a low base impact and stuff like that. But yes, it certainly picked up. So, full marks for that.
All right. Well, on that note, let's get you the verdict from the street. Here are reactions from key economists after the GDP numbers last evening.
There are definite signs of a turnaround. The idea that the economy is going into a continuous decline has to be junked now. So, and I read a lot of positives in the data which are not immediately obvious. For example, construction growth is low, but there are indications that, this low-income housing, there's a lot of interest in it among entrepreneurs. We're beginning to see signs of investment in that. So next quarters, that could also turn up. The numbers are quite good, suggest that the impact of GST and demonetization before that on the informal sector has waned, has revived. Because, big worry was there was a loss of unemployment, but was it going to be persistent? Or was it a temporary layoff and people would come back? So these numbers suggest people are back and those jobs are back. And if you see greater formalization, that would be good from the point of view of raising credit in the future.
What we need to focus on is not so much on just on the headline, but also on non-agriculture, non-government or public administration, GVA. And that number has actually picked up very smartly. It was 3.8, went to 5.5 last quarter, and up to, I think it's about 6.8. My arithmetic is right. And I think that suggests a pretty strong, the private sector economy, private sector non-agricultural economy, that has rebounded quite smartly from 3.5 to 6.8 in 3 quarters, and that's a very good sign.
Construction is critically important at this point, where employment has become a major issue, both economic and political. After agriculture, construction is the single largest employer, and any problems there are going to get reflected in future trajectories.
Well, we can only hold on to hope, because a lot of the construction companies are telling us that business is really picking up and orders have really started coming in. So maybe...
NCC said that,
yes. Yes, NCC, Sadbhav Engineering. In fact, there's an upgrade this morning on Sadbhav Engineering that they're getting a lot of work. So maybe construction numbers will look better in the coming quarters. But on that note, let's take a look at what our wise experts have to say as we get into trade this morning. The big call on India is coming in from Credit Suisse today. Alexander Redmond says they are 15% overweight on India. He believes that Indian equities are poised to begin outperforming again and reverse their 7-quarter long underweight stance on the market to a 15% overweight. He says they turn constructive on the near-term investment case for Indian equities as growth looks set to recover following temporary disruptions. He adds the outlook for credit growth improves with the bank recapitalization and feels the macro environment should remain supportive with further monetary easing. Alexander says earnings revisions have finally turned neutral again, and their macro regression model suggests a 19% upside to potential year-end 2018. They are relatively sanguine on the short-term prospects for the rupee. He says investor positioning and sentiment leaves scope for reaccumulation, and long-term structural arguments to overweight India remain intact. However, he adds valuations continue to look stretched, but are more palatable combined with strong EPS growth. Get all of that except the monetary stance. I don't know, Latha, if the Reserve Bank of India is going to be so obliging. I mean, they expect, Credit Suisse expects easy monetary stance. I don't know. You're the better judge of that.
No, I mean, from this Reserve Bank, I don't see why they should. If the economy is picking up, it would actually be, it could be dangerous actually to have a loose policy at this juncture. They're anyway neutral, so to expect a cut at this juncture, I mean, at least it looks very difficult. But we have Deepali Bhargava, the economist from Credit Suisse, joining us now, so better able to explain this. Good morning, Deepali. Thank you very much. Well, how do you read the GDP numbers? We were saying that the non-agri, non-government number, just the private, corporate and manufacturing and services number looks like a 6.8% growth. Are you that optimistic?
Hi, morning, Latha. So I think what we're really reading from the numbers is it's just a manufacturing-driven revival. And honestly, it's not come as a surprise to us. We do this composite leading indicator where we put all the indicators that drive investment. We put it together, and we were expecting a very sharp rebound in investment, and primarily because of the restocking which happened ahead of after GST implementation and because festive demand. So besides that, I think to look for a very broader source of recovery is clearly missing from these numbers. Government expenditure was weak, and I think it's grown at about 12% in the year so far. Growth will moderate to about 3-4% for the rest of the year. Exports, we think there could be some bit of over-invoicing, which has already happened in the numbers that we saw. So although we're very positive on global demand, etc., I think there could be some extra push that could have come from exports in the numbers that we saw as well. So I agree that long term next year we're more positive because we're positive that GST revenues are going in the right direction. We're also positive that a bank recap will result in bank lending credit growth moving up from 7% to about 11-12% next year. But I think all that is really the next year story. This year we continue to think that there will be disappointment on growth, and especially with respect to consensus and where RBI
So what is your full year forecast and your second half forecast?
So full year forecast is at 6.6, which still means that you need a reasonable
you need a 7% plus.
7%. Yeah, you need a 7% plus. So one thing is you have a positive base, especially after demon and all. But I agree that even to reach our numbers, which is like really clearly below consensus, you need a significant rebound there. And with oil prices clearly moving up and government spending remaining weak, I think the risks are probably to the downside, I would tend to think, even to our number.
Oh, so Deepali, you're not enthused by, let's say, what manufacturing has done or the strength that mining has exhibited in the second quarter. Where could the sectoral disappointments lie in the second half? Because you're not expecting a strong second half.
Right. So like I said, it could be. I mean, it's still very early to say. I would think to just extrapolate this rebound in manufacturing and just assume that you're going to be in the 7% zone for the second half. What we're saying right now is it's just primarily a restocking impact. And so you've seen consumption also slow down, right? So look at the auto sales numbers coming through, and they're clearly slowing down in the October month, something which also reflects that it was probably just a bump up from restocking.
Yeah, no, I take your point about exports. Even with the bump up you saw in September, it's only a 1.2% growth year on year in exports, and especially at a time when the world is growing. But what's your FY19 number now?
So FY19, we are at 7%, and I think we're pretty comfortable because that's still a massive acceleration from 6.6.
Oh, right. Well, point taken. Deepali Bhargava, thank you very much for joining us with your thoughts this morning. But I would interpret Deepali's numbers as very positive. Because if you looked at 5.7 and 6.3, the first half average is actually less than 6%, 5.85 or thereabouts. So if you want a full year of 6.6, the next 2 quarters is actually 7 and 7.5 or something like that. So what do you have 4 quarters? 5.7 first quarter, 6.3 second quarter, even by Deepali's estimates, 7 in the third quarter and 7.5 in the fourth quarter. I mean, I'll take that with both hands.
Absolutely. I think the market will too. You said it, Latha. In fact, speaking of the market, now let's also just go back to the global picture and talk about what's been happening in the US, because lots of action there overnight in the last 10 hours. Over to Mangalam for the world view.
You said it. Lots of action in the US markets yesterday. The Dow moved and how investors said, wow. And after that, the tax reform was delayed. So now they're saying, what now? If you take a look at the Dow Jones crossed that 24,000 mark. Senator John McCain agreeing to support the bill was the key trigger for the Dow. But that has been postponed from Thursday night to Friday 11 a.m. So it is a matter of when and not if that is passed. Oil meat, crude oil prices surged higher as the Vienna meat had a positive impact as far as cutting production is concerned to the end of 2018. So 57.4 thereabouts is what the crude oil traded at. Across the Atlantic, we saw some red tick on all the 3 frontline European indices. FTSE being the key underperformer over the last few sessions. It has been roughened up by the stronger pound that we're seeing across. Right.
No, I'm sorry, Mangalam. I'm really sorry to disturb you. Thank you very much for that wrap. But we have to get to a very important breaking news that has come in. I'm sorry to disturb you when you were telling us about the global wrap. It's because Biocon has got the US approval for its long-awaited drug, trastuzumab.
It's the EMA approval.
Okay,
so we just need to make sure that I think it's the European Medical Agency approval. And it's not the US FDA approval.
Okay.
But nonetheless, that's still very big news for Biocon because...
but weren't we waiting for the US nod by Sunday?
Which is also on Sunday. Which is also on Sunday. So generally, they could probably get even, approval even before the target action date. But this is a big, big positive for Biocon in any case. To even get European approval for trastuzumab, they've gone through a long process when it came to that. So it'll be interesting to know what exactly happened. But this is the European approval. This is not the US approval at this point in time. But having said that, it's still a big deal.
But Ekta, so let's just rewind back a little bit. Obviously, this was one of the marquee biosimilars for the company. There are already come to the market, and therefore the sort of opportunity for Biocon?
For Europe, either way, for an Indian company, even in partnership.
Okay, I think we have Kiran with us.
We have Kiran with us. Ma'am, hi, thanks very much for joining in. Can you just take us through exactly what this news means? You've got the European approval for trastuzumab, so when exactly...
Actually, you've forgotten to say many congratulations, Kiran, first.
And congratulations.
Please, let me just correct you. It is not an approval. This is just an acceptance of our resubmission.
Okay.
If you remember, we had to withdraw our file. And now we have resubmitted, which means that they have now accepted it for review for MAA. That's all it means.
Okay.
And it also means that that they have they are now going to review it, and we are in line now. We are very optimistic that we will get the nod when it is finally reviewed and dealt with.
Okay.
Because if you remember, we need re-inspection of our facilities. That was the only thing wrong with our submission.
Okay.
Now they have accepted, effectively it means that they have accepted the CAPA plan, which they will re-inspect and then they will approve.
Fair point.
So that's all it means, and that's all it means that there is sort of some light on this matter, because for a long time people were concerned about when we would resubmit. And what would be the optics along that?
Okay. What about the US? What about the US approval? Are you expecting it by Sunday?
Well, the US approval, the target action date is on the 3rd, and we are keeping our fingers crossed. But I'd also like to remind you that although there has been an approval accorded to Merck Biopas for the trastuzumab in EMA, in terms of commercialization, we believe that we are in time to meet the commercialization timelines, which even Merck will have to adhere to.
Okay. So, ma'am, just to get this clear, there are no technical issues with the European application for trastuzumab or for pegfilgrastim. It is just based on the observations that you had received. Okay, so when exactly can we expect a reinspection and a follow-up to that?
So it means that the moment they accept this MAA application from us, it means that the inspection should happen in the near term. That's all it means.
So maybe in the next 3 months, or maybe if you can give us a time frame?
that's what we expect. Yeah, probably in that kind of time frame.
And how big an opportunity is trastuzumab in Europe for you?
Well, the present market for trastuzumab between Europe and US is about upwards of $4 billion. And for the rest of the world is another $2 billion. So it's like a $6 billion opportunity globally.
Okay.
But, with genericization, we believe that there will be an expansion of the market.
Fair point, ma'am. Thank you very much for joining us, Kiran. And all the very best for both Sunday and for whatever the European approvals that you are waiting.
Thank you.
Okay, so that's another big news, positive, but we are awaiting an even more positive news probably on Sunday. But we need someone to put all this in place. The global markets, especially the US, has been reaching out to newer and newer highs. India in the last 2 weeks has not quite participated, nor have the EMs, but this GDP number could make a difference. Arvind Sanger, Managing Partner at Geosphere Capital Management, joins us. Good evening to you, Arvind, and thank you very much for obliging by staying up and waiting for us to finish our early morning news. How do you read the GDP numbers? Do you think this can make a very big difference to foreign investor approach to India?
No, I think it's slightly positive, but I wouldn't take this as anything transformative. I mean, clearly we know that there was a lot of destocking that happened pre-GST, and so this was in the quarter where GST was implemented, the September quarter. So it was not expected to be clearly a destocking quarter, but it was still a transitional quarter, and therefore, the GDP numbers are okay, but obviously not where we hope for them to be. So I think this kind of confirms that June quarter was the low. So in that sense, is a positive. But it doesn't confirm that we are headed to a 7.5 to 8% GDP growth, which is what our hope is for FY19 when the effects of GST, the positive effects of GST start to show up. So in that sense, it's a transitional quarter. It is moderately positive, but it's not something that causes people to, I think, investors jump up and down and say, hooray, all the worst is completely behind us and we're off to the races.
Okay, Arvind, take that, tempering and slight sense of caution. Onto the US market itself, in this high drama that's playing out in the Senate. I mean, this is overnight move. I mean, for us, overnight, for you in the day, obviously. This big rally that we've seen, and now the vote has been pushed back by some 24 hours. What's the sense? Is it just a question of when and not if? Because I'm guessing a lot of the last leg of this rally has been based on the fact that taxes are going to be cut. Does it look like they will be?
Yeah, well, I think it is critical for the Republicans and for the stock market that a tax bill does pass, because if the tax bill collapses, then I think the market would have lost one of its major crutches. In fact, I'm afraid even if the tax bill does pass, you could see a little bit of a sell on the news syndrome, because the market's come a long way counting on the benefits of this tax cut. And hopefully we will get something passing through Congress. But as we've seen before with Republican efforts on health care, Obamacare, that they seem to specialize in kind of taking it to the 11th hour, and then hopefully at this time not snatching defeat from the jaws of victory, because healthcare wasn't that important for the market, but tax reform clearly is important, and making U.S. corporate rates, and I would emphasize this is mainly about U.S. corporate rates. It's not so much about individual rates, which gets thrown in the press a lot, but this is mainly about restructuring U.S. corporate taxes to being much more competitive versus their global peers. And if this does pass, then that is one of the reasons the market's optimistic, is that it does help U.S. companies relative to global competition.
Yeah, but Arvind, we also got 2 quarters of over 3% GDP for the US. OECD numbers OECD also says the European numbers can be upgraded. Is there a preference among investors for developed markets over EMs now?
I don't think so. I think that goes back and forth. Clearly, the developed markets are now in a improving cycle in terms of growth, synchronized improving. But, usually that's the time the emerging markets also do well. Now, U.S. is leading the charge in terms of a tightening cycle, but I think we should start to see QE winding up in Europe, and so that, is maybe a few quarters and year plus behind the U.S., but it's headed in the same direction. So all of that could be potentially seen as a headwind for emerging markets if interest rates are tightening. But I think the pace is so gradual that I don't see that as a major headwind. And so as long as synchronized global growth is going on and emerging markets are participating and benefiting from that growth, and obviously India is an example of that, that if it does, now we've seen some disappointing export numbers in the last couple of months, partly related to GST and some of the tax issues for exporters. But I think, once those issues get ironed out and hopefully the government is fully cognizant of those issues, I think India is also going to be a beneficiary from this global growth. So I don't see that as an either-or.
No, Arvind, therefore, what are you doing now in India? Are the corporate earnings numbers and GDP numbers enough to make you continue to buy at current levels? And if yes, what?
Well, I think, one of the things that we saw, which was slightly disappointing in the GDP numbers, was that domestic consumption is showing signs of continuing to slow down. And on the other hand, you had some domestic investment numbers which looked slightly better. So I think we're looking at, areas where the investment cycle might benefit, whether it be, from infrastructure-related spending or anything else that might benefit on those lagging sectors. We saw things like, hotel and related, some of that area showed some strength, so we like that. But I would say that we're frankly being a little bit slow to get aggressive here, because we still think that that there's not any great straight moonshot, and you have a Gujarat election which we are watching closely, but we don't expect any big shockers there. But there is a moderate or small amount of risk there if that result turns out to be much closer than expected. But other than that, I think we're just looking at data points, including oil prices with the OPEC agreement today. Oil prices didn't seem to run away. So I think we're looking at different data points, and we're remaining constructive, but we're not jumping up and down and saying we got to own things right now. We continue to look for values where we can find them, and valuations, as we've said before, are somewhat full for some stocks, so we have to be selective.
Okay.
All right, Arvind, thank you for your thoughts. Good talking to you as always.